Are you looking to invest for a big return but are unsure which suburb is up and coming and guaranteed to give you the most bang for your buck? Smart Property Investment and Pure Property Investment have unveiled the Fast 50 2024 report, identifying the suburbs backed by research that are giving investors the highest returns. Don't make any investing decisions until you read the free report. Visit smartpropertyinvestment.com.au to download the report.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Oh, g'day, how you going? Phil Tarrant. I am the host of the Smart Property Investment Show. Hope you're well. Hope you're trying to navigate this market. I know there's been a lot of questions right now about whether or not we're at terminal interest rates, and I'll probably ask my guest today what he thinks about this. But I was of the opinion at the early May that we'd probably hit it, and I was sort of 50-50 on whether or not there'd be a rate rise, and we all know there was one. I've been reading quite a lot about what the banks are saying, and some of the banks are saying that's it. Some of the other banks, they say, I think Commonwealth Bank falls into the that's it category. There's no more. There'll be rate reductions in 2024, but there is still a handful of lenders. I think NAB reckons there's going to be at least two more rate rises. So who knows? It's a national pastime now trying to work out what the Reserve Bank of Australia is going to do with interest rates. We know that there's been recommendations handed down recently around changing the way the RBA works, whether or not there should be two boards, one that sets monetary policy, one around governance to help sort of inform their decision-making more appropriately. I know there's a lot of Australians really starting to hurt now with these interest rate hikes. Fortunately, APRA had put in measures to put buffers on interest rates. So the money that you were borrowing a couple of years ago was probably at least had a 3% buffer on top of it, but we've now absorbed a lot of that. So I think the reality of what it means to be a mortgage holder with rates at this level is really starting to bite, and whether or not we're going to start seeing distress selling, it's to be seen. But this is the market we're operating in right now. I subscribe to the idea that we're pretty much at terminal interest rates. It shouldn't go too much higher. There may be one more, maybe not. But subscribing to the point that you will start seeing reductions at the latter part of 2024. I'm not an economist, however, so that's just me at an aggregate level absorbing information and working out what I think around it. That said, though, it hasn't dissipated the love of property investment with Australians. I do know, though, I did read something yesterday saying that the tax office is going to be looking closely when you're doing your 2023 financials around interest rate reductions. So a lot of Australians invest in property. A lot of Australians get the benefits of capital growth through property. A lot of Australians get some taxation benefits through investing in property, and that's really structural. That's okay. Just be very, very careful. But the love affair of property and investing in property as a mechanism of wealth creation is alive today, is what it has been, even though there is quite a lot of headwinds for property investors. But the smart investors I know, they understand the headwinds and they look at how they can change tax. Sorry about the nautical analogy there, to actually continue to benefit and drive forward. Some interesting research has come out recently. It's done by our friends over at Momentum Wealth. They did their property sentiment survey. And I like this sort of stuff because it gives a lens for how different cohorts or cadres of people see the world. That's sort of 800-900 respondents on this. So I wanted to pick this report apart with the managing director of Momentum Wealth, Damian Collins, a regular person I bring onto the show. He's the man that I turn to for anything Perth orientated, but he does buy property right across Australia in Momentum Wealth. Probably one of the longest standing buyers agents in Australia. Damian, how you going? You well?
I'm good, Phil. Good to be here again.
It's good to see you, mate. And I hear, I haven't seen you for a month or so, and my sources tell me that you've been in America lurking around property markets and doing different things. What's your sort of headline for us Aussies here? You know, and they say when the US catches sneezes, Australia catches a cold or whatever it is, we're intrinsically connected with our friends over in the States, the engine of the global economy, both at an economic level and also at a security level now with all this AUKUS arrangement. So we're tied to our friends in the States. How's it going over there, and what's your sort of view of that and how it might sort of impact Australia, mate?
Yeah, interesting, Phil. I was there for nearly a month, and I spent a lot of time up and down the east coast of the country. And look, they're hurting a bit more than us. Their rates are now over 5%. Their central bank rates, and one of the challenges they have in the US is so much of their market is fixed rates. So most people take out 30-year fixed rates when they buy a home. Whereas in Australia, historically, we've been very variable. So it's easier for the central bank in Australia to put the rates up, start to hurt people, and consequently, they don't need to go as hard and as high to get some reduction in spending. We've seen that in Australia. Retail sales the last 2 quarters have been down, but because a lot of people take fixed rates, if you took a fixed rate and bought a home in 2020 in the US or even into 2021, and 30-year mortgage at 3% all this stuff's not hurting you unless you lose your job through the downturn in the economy. That's where it might hurt. So certainly the rates are higher, certainly inflicting a little bit more pain on those who are affected by it, which is people who've got variable rate mortgages or people looking to get into the market. So, but they're fundamentally in a residential context in the same boat as us. They've got a shortage of housing. They're, I looked a lot of time at their build-to-rent or multifamily market. They've still got this shortage of housing. Rents are going through the roof. The migration's picked up again after COVID. So fundamentally, the housing market's in pretty reasonable shape. It's certainly hasn't seen any declines of any significance. Certainly, we're further ahead in terms of declines. So I think some of the high-cost cities, Silicon Valley, around that area, New York, might take a hit because of some of the job losses in Silicon Valley. But fundamentally, the housing market's in reasonable shape just because of the same situation as us, the too much demand and not enough supply. The commercial markets are similar to us, industrial properties, the hot sector, retail's doing it pretty tough, and office is doing it even tougher. So they're just not getting people back to work. I spoke to someone in New York who's got 300 staff and 30 go to work any day. So he said, as soon as my lease is up, I'm cutting the guts out of that lease space. So the office market over there in the big high cost cities, less so in the Sun Belt and the lower cost areas, but the big high cost cities, I think their office market's in for a bit of pain for some time. So it was good. That's my 2-minute summary of a month. But it was a great trip and learned lots. And it's always good to see what's going on the other side of the world and how that might affect us.
Yeah, so it's quite a lot of parts to that. Did you chat any mortgage brokers right there? So if you're buying property now, you're probably taking on variable rate loans, thinking that you're not going to take a 30-year fixed at a high rate, or there'll just be a spate of refinancing in a couple of years' time when the pressure on rising rates ameliorates. How do you think that will play out?
Well, the amazing thing about their capital market, so you can take a 30-year mortgage rate and you can break it. In Australia, we know if we break a mortgage and the rates have gone up, the rates have gone against us, we have to pay a penalty to break that rate. So if they've gone down, I should say, if you fixed at 5% and you want to cut it and refinance at 3.5%, well, you got to pay a penalty. You don't have that in many cases over in the US. So people tend to fix more, just lock it in, and at least they know certainty, and they refinance when the rates come down. So look, I think there's a lot of it has stalled the market though, because there are a lot of people now who would like to move, but are locked into those fixed rates of 3% for 30 years. They know if they move, they've got to pay now 6 or 7%, 6.5%. So it's stalling the market a little bit. That's one of the downsides of that system. People just don't move. It's not just the property that's a consideration; it's the mortgage they've got, and they know they can't get that again. So I think their volumes are stalled, and I think that's going to stall the market for some period of time.
And that's the supply side, because if property's not transacting, it does a lot to prices as well. So interesting, but it's good on the way down. If you can just keep breaking your mortgage, and every time you get an interest rate cut, imagine everyone's just refinancing. Great for mortgage brokers, but then you stifle at the bottom end. So, largely if you could play the mortgage game correctly, everyone should be on the lowest rate possible at any point in time. But I find it absolutely intriguing how the two do. Fundamentally, they work similarly, but it's very much more state orientated over in the US in terms of taxes and everything else interconnected with it. But I'll keep an eye on the US market. Interesting around commercial properties, and you got the same problem here. You're probably reading in the papers over in WA. Same thing here in Sydney. Everyone is now lamenting the demise of CBD economies. All of the supporting mechanism around getting why people come to the office, whether it's fashion retail, is towards commercial fashion retail office space. there is big organisations now who are lobbying pretty hard to force sort of return to work, but I don't know the answer to it. I don't know if you're going to be able to get people back into the office, or what needs to happen to actually give organisations the mechanism to force people back in the office. It's a tough one, and I think it's going to erode the office market for decades, right, before this can be turned around, or a new status quo emerges.
Well, I think certainly in the high-cost markets like Sydney and Melbourne, and the high commute, that's the other thing too. If you're in a smaller market and your commute's 20, 30 minutes, you probably don't mind coming in a couple of days a week, and companies can say, look, we want people in 3 days a week. But if you're on the up in the Central Coast and you're commuting into Sydney and your boss says, come in 4 days or 5 days a week, you're going to go, I think I'm out of here. I'm going to look for another job, particularly in low unemployment markets. So it's fundamentally changed the office market. And I think, and also landlords or investors, tenants, I should say, that guy in New York is saying, I'm going to cut 60% of my lease. He's going to save millions a year. You're going to find a lot of buildings, a lot of tenants are in the same boat going, well, I can work for, maybe 50, 60, 70% of what I had. So it's going to be worse. The higher the cost city and the more the commute time, the harder it's going to be to get people back, and the more inclined the tenant is to cut the space because of the cost savings. So, I think, and as you say, like fundamentally, you'd hate to be a CBD retailer. I feel sorry for them because those people are never coming back to the levels they were. So it's going to be a tough time for city retailers and for office space, particularly in those high-cost cities.
Yeah, and it gives some views towards, if you are investing in commercial real estate, which a lot of our audience does, where you should be targeting looking at it. Then it's all exacerbated by the high cost of living, right? People are going, I'm struggling to pay the bills. So if one thing I can cut is $50, $60, $100 a week in travel expenses, well, what are people going to do, right? If they can manage it, it's an easy one to give away. But, on the flip side of this, everyone's chatting about it professionally, saying that you're going to end up with a void of a different caliber of leadership moving forward, because it's in a personal environment where you are face-to-face with people that those skills are developed. So you're going to have professionalism is probably not going to be as well-rounded as what it has been in the past. Then you get this two-speed argument as well, saying, well, why should white-collar workers get a choice around this when, doctors, paramedics, builders, cleaners, like they don't get the choice. They've got to go to work, right? So, it's certainly the haves and have-nots, but, this is a show around property investment. So what does all that mean? Well, within a commercial sense, what asset classes to be looking at. I know you're big in your, I guess a connected operation views, Westbridge Funds Management, very big in the commercial side of things. And we've spoken about that in the past, Amy, but it should also give resi investors a bit of a lens from which to look at residential property investing. So, are young professionals now choosing to live, within the CBD, let's call it Surrey Hills, right? Because that's where they used to be, close to work and close to where they could play. The world's changed quite a lot. So, does the old paradigm of investing close to a capital city within 10 kilometres or whatever it is resonate anymore? Or is it about sort of micro, mini satellite CBDs now is where the real gold lies? And, your report, Damian, has sort of given some sense to the passion for property investment is not waning, but how you go about doing it is very different. So I want to sort of drill into that a little bit. We'll just go to a quick break. Stay with us. Back in a moment.
This year might just be the right year to invest in property. But before you jump in, do you have a low-rate investment loan pre-approved? It might be the right time to invest, but the wrong loan could dent your prospects for achieving the maximum return. Are you armed with the best finance at the sharpest rate? Find out with Finny. Call us now on 1300 002 023 and find out what you could save. Or visit our website, finny.com.au to book an appointment.
Welcome back. It's Phil Tarrant, host of the Smart Property Investment Show with Damian Collins. He's the Managing Director of Momentum Wealth. 900 odd responses, Damian. So this is your client base has responded to this. So these are people who you've either bought property for or you have some other professional relationship with them. I know you have quite a large property management business there, or people who you're working with in the background. Give me a sense of the people who you've surveyed as part of this so we can sort of shape a chat around it.
Yeah, Phil, it was our client base, but also we use some external databases, including the fabulous subscribers to Smart Property.
The smart ones. So you got
smart
a
ones.
really good one.
We did send it out. We did send it out far and wide. It was quite a broad spread of respondees. We had almost half from New South Wales and Victoria, quite a lot from Queensland, South Australia, And WA was represented there as well. So it was quite a broad spread. And, as you say, interestingly, the trends were there's still quite a lot of appetite for property investment. People are keen to get into the market and where they can, and they see the great opportunities that are there. And we all know that it's the last 12 months has been somewhat challenging, but with prices down in some capital cities and down by a decent amount, but people still fundamentally the long term that residential property in good locations in growing cities is still got fundamentally good value and a good way to make some money over the longer journey.
So why, despite, and a lot of it's media driven or sentiments, it's, the market is between your ears. Why do you think, despite the headwinds facing investors at the moment, higher interest rates, serviceability constraints, higher cost to get into the market, uncertainty around government regulation and bureaucracy, uncertainty around the tax regime, those Australians still keep coming back to property? Why? Is it because it just works?
That's interesting. Yes, having been in the US, there is certainly people like property in their home, but you don't have that clamour to build a big residential portfolio. They tend to be more stock focused, and that's like, I guess historically people look at where the money's been made. And if you lived in the US for the last 25 years and you bought Apple shares or Amazon or one of those, stock market, even despite the ups and downs, people have made a lot of money there. And we all know in Australia why people like property, because over a 30, 40-year journey, it's been a winner. We, us people in our middle age, look at our parents and how well they've done, that 70-plus generation, and how they've, held property for long term and maybe bought an investment property too on the way. They've made good money. And so people in their younger generations look towards that and say, well, that's a good spot. And look, it's certainly not risk-free. I think people have to realise that residential property is definitely not risk-free, but historically it's been lower risk. And historically the volatility, the downturn we've seen the last 12 months is only, really the second time we've seen in 20, 30 years where prices have come down 10% or more. That doesn't happen often. So whereas the stock market, of course, we know can drop 40, 50, 60%. So I think it's fundamentally, Phil, it's the fact that people have seen it's been a winner for a long time. They feel it's reasonably safe. It's not guaranteed. And they see opportunities in the years ahead to make money. And I've always, my philosophy on this has always been, a country and a government cannot run if house prices drop 40%. The stock market can drop 40% and life can go on. If our house prices drop 40%, that's going to be pretty calamitous for the market. So interest rate settings, while they obviously say they don't take into account house prices, fundamentally, if house prices drop that much, it would kill the economy. So yes, you're going to see volatility in house prices, but I just don't think you'll see the volatility like you do in other asset classes. Hence why people feel that confidence to leverage into it and buy and build a portfolio.
And hence the reason why when the Reserve Bank gets together to try and work out what they're going to do with interest rates, they always have an eye towards the property markets. Obviously, interest rates impact other lending, but most Australians hold their wealth or their largest sort of connectivity with debt within their property. Now, it's clear that property investment is absolutely a national support for all Australians. And if you think how it's all set up, it would be, dire if property prices in Australia sunk to 40%, like you see in the share market. You have international commentators always pointing to Australia saying property's overpriced, it's a bubble. They put it into the paradigm of what the reserve of the sort of World Bank metrics around the ability of Australians to pay off debt. I think it's really high. It's like 9 to 10 times of your earnings is the value of property. And they're saying, Australia is a bubble weight and the burst is one of the highest in Australia around it. But we need to remember, particularly as property investing, this being a podcast for property investors, is that property investors aren't investing in isolation. They have two really, really big and strong friends that they're investing alongside of. One is a bank, because most investors I know, particularly sort of early on in their investing, is investing with debt, leverage. So a big bank is ponying up 80, maybe 90, maybe 70, maybe 60% of the funds. So they're highly invested in the strength of the property markets. And then structurally, the Australian government has said, well, if a third of Australians rent, we need to provide rental stock. We don't want everyone sucking on the teat of public housing. So let's incentivize Aussie mum and dads to be property investors. So in America, you would have seen it, Damian, they have a lot of build to rent type of scenarios, same into Europe, which really isn't a way there. So I can see why Australians like property investing, because if it's something you're going to back, if you lose, banks are going to lose and the Australian government's going to lose. And we only saw in the budget recently that being in the black rather than the red. The reason why is because tax receipts are so high these days because Aussies have jobs, and jobs are intrinsically connected in with the healthy economy. The healthy economy is good, and normally property markets are good. So everything lives symbiotically together. But it's a tough one to pull apart if you're not an Aussie, I think.
Yeah, and I think the other thing, I read those World Bank and OECD comparisons. What they forget is Australia is a coastal city. You can compare the house price of Sydney to Kansas City, Missouri, or somewhere in Iowa, and when they've got lots of land and lots of sprawling out and no population growth and 500,000 people or whatever in those cities, every coastal city around the world is generally expensive. If you go to, having spent now, been in Miami, Philadelphia, Boston, New York, they aren't cheap housing markets. Their housing price, New York's obviously a world of its own, but even in Boston and Miami, good quality prices are just the same as you see in an Australian city. California's worse than Perth, Adelaide, Brisbane, and Melbourne, maybe on a comparison to Sydney. So, and it's simple. Coastal cities, people want to be near the coast. Supply is limited and demand is strong, and that's why you see it. So I think it's an unfair comparison to say Australian overall house prices are higher. There's a bubble. I think you've got to look at it in the fundamentals, and all our major cities are on the coast, limited supply and high demand. People want to be there. That's why they might be above the global average, but there's a reason for that. If you compare us against the California, even Vancouver in Canada, we're not cheap, but we're certainly not over the top as some of those forecasters and analysts would say.
Yeah, you got to think also, Australia's got an interesting story, and it goes back 40, 50,000 years, but the sort of the immediacy of settlement a couple of hundred years ago. We've been a wealthy nation for a long time. The early days of Australia under sort of the British regime, it was a tough few years, but they started digging stuff out of the ground pretty early on around Ballarat, which I think is your old sort of neck of the woods, and we've been a wealthy nation for a long time. So it's not a new idea. It's not a new paradigm for Australia to have wealth, and wealth effects is expensive property. But you've been in America, Damian. A lot of people forget this. If you picked up Sydney or picked up Melbourne and put it into America, they're major cities, like they're top 10 cities in terms of population size. They're probably probably changed a lot to probably maybe the fourth or the fifth largest cities if they were in America, outside of maybe New York and Chicago and maybe Los Angeles. Like they're big global cities, and a lot of Australians forget that. But that gives a sense to the Australian market.
Absolutely. So the Philadelphia, where I was, is the sixth biggest city in the US, and that's just over 5 million people. So there you go. Sydney and Melbourne are in the top, as you say, top 4 or 5 cities out of 50, 60, 80 cities across the US. You're right. There's New York, LA, I think Chicago, maybe Dallas, Fort Worth is
maybe
bigger.
Dallas, Fort Worth. And you think of places like San Francisco, right? Like that's only a population of 1 million odd people.
Yeah, I think if you go
down through the valley and some of those other areas, but San Francisco as a city is small.
Yeah, so I think that's exactly right in context. Sydney and Melbourne particularly are very large cities, and it doesn't surprise me. It's just economics 101. The bigger the city and the more coastal it is, the higher the prices are. And that's just people will pay out more of their wage, more of their business income. They'll scramble and save because they want to live in a great city that those cities are.
Yeah, and why not? And back to the cinema survey you put together. So what was the leading investment goal then for Aussie? We've just had a love affair with Australian property just there, and all the reasons why Aussies want to be involved in it. But what's the leading goal for property investors?
Well, really, the most surprisingly, still there was getting another investment property. 23% of investors wanted to get one in the next 12 months. They identified, obviously, some of the barriers there. Interest rates rising has certainly made it harder to, and some of the cost of living challenges, but still people are pretty keen to get in the market, and 23% is a big number. Obviously, these people are interested in property investment. They're on our databases, but it certainly hasn't, the interest rate rises, all the conversations out there in the world haven't diminished their desire to continue to build a property portfolio, which is good to see.
Yeah, it is good to see. And we need to remember, or put it in perspective, if you've been investing for some time, this might be the second, third cycle that you've been involved in. There's always people who are new to property investing. So it's irrelevant, the market that they're operating in. If they're ready to, if they made the conscious decision to start investing in property and they've framed and shaped their ability to do that, well, this is the market that they've got to play in. So, everyone always has this question, when's the best time to invest in property? Well, the time to invest in property is when you can invest in property. You can't sit around and wait for the perfect market for it, because you must see it time and time again, and working with the clients that you work with, that you just never end up doing nothing.
Yeah, I've seen that happen. People wait for that perfect time, and it's like any investment market. We'd all like to pick the exact bottom and sell it at the exact top, but that's not how generally it works. Very few of us can get that perfect. I've got it right a few cycles, but I've still bought it what you would say not the bottom of the cycle. I've bought it in the mid section of the cycle, and I've still done very well. So people certainly fundamentally feel confident in the Australian property market. I think a lot of people have seen the opportunity, particularly now we've seen the prices come down, nationally 10%, but, Perth hasn't come down at all, and Sydney came down 13%. That's obviously turned. I think people saw it as an opportunity. And I think the other thing, Phil, is that there's a sense now when the interest rates started going up, people would go, well, when's it going to end? There was no sense of when it might end. Now I think we're all feeling fairly confident that if we're not at the peak of the cycle, we can't be far away. There's just no sense out there and anywhere. And I follow the bond market, and the bond market's forecasting, we're going to drop 0.75% within 12, 18 months. We've pretty much peaked. They can be wrong, of course. This is bond investors and traders, but there's certainly no sense out there, I think, by anybody that we're going to go up another 2% or anything silly like that. I think the sentiment is that if we're not at the top, we're pretty close. And I think that gives that historically, if you look back over the time, that's when people start to feel more confident again. It's the uncertainty that stops people from investing, and that's why we saw the declines over that sort of 18-month period or 12-month period. But now that the sense is, well, we got clarity on where things are. So, there's not that fear of the unknown. And that's what's giving, I think, people more confidence to get back into the market.
How do you, I'm conscious you've been investing for quite some time. You've got a considerably large resi property portfolio. You do most of your investing now outside of that in commercial. And that's the typical journey of someone that's been doing this for a little while. How do you stay connected with your clients on the basis that you've got people who are just starting their journey, or they might be relatively new to property, they might have one or two properties? How do you sort of get yourself back to that base level where you're talking about people investing in $350,000 properties, which, you probably personally moved on from some time ago because of the nature of the maturity of your portfolio and the cycle that you're in. But is it largely still the same? Like the price becomes irrelevant because it's horses for courses. You buy what you should be buying at a point in time of your growth as a property investor?
Yeah, I think the numbers are probably secondary. Obviously, it's all relative for each person, how much they can afford and what they're looking to do. I think one of the interesting things that came out, which is still somewhat surprising, but I guess you would hope it would be we'd see less of it, is the fact that a lot of people don't really have any plan for investing in property. They've got, I'll just go and buy a property and it'll be good. And they don't have any strategy. So is their strategy to go out into the, is their strategy to hold it for the long term? Is it to renovate it? Is it to develop it? How many properties do you want to build over that journey? What's your, the other thing I think is important is what is your profile? Like if you talk to people and they say, I want to buy something I can develop it in 5 years. That gets a lot of people excited. But when we sit down with clients, we actually go through, well, that sounds good in theory, but let's talk about your risk tolerance. So how are you going to go with cash flow? Because it's something that you can develop in 5 years is going to be pretty average, ratty old home generally, and your rent yields are going to be low and your negative cash flow. And they go, oh, okay, well, I didn't think of that. And, and then your repairs and maintenance are going to be more because you're not you got to keep it together so the tenant can stay there, but you're not trying to make it too pretty because you want to bulldoze it in 5 years. And then the tenant's quality. You're not got a quality property, you might get same lower quality tenant perhaps. So all those things, but then when you sit down and go through that with people, they change they go, oh, okay, that makes sense. And they start to adjust their expectations about what suits them and their circumstances. And I think that's still important. I think encourage every investor to get out there. If you're going to go into the property market, do some self-assessment or go and talk to a firm who does property strategies and property plans and figure out who you are, your cash flow capability, where you want to get to, and that will certainly give you some good advice and some goals about what might be the right properties. I've seen too many people buy that investment property for redevelopment, then they get 2 years down, the tenant's giving them headaches, they've got to replace the hot water system, they're losing money, maybe the market was a bit flat for a while and it all gets too hard and they bail out. And that's the last thing you want to do, is get into a property you have to bail out. So getting that plan in place, and surprisingly still we had more than half of survey respondents say they had no plan in the property market. I think that's a fundamental mistake, because property is not cheap to transact, as we know, Phil. You've got 5% or thereabouts on the way in, you've got 2 or 3% on the way out. It's you don't want to get in and out of the property market generally, unless you're an active developer and trader. For 98% of investors, it's something you want to buy that you can park away for a decade or 2 decades. And so that's why it's so important to get a plan, a strategy up front. And still, sadly, a lot of people aren't doing that.
And it's good to have a goal and a vision starting off. And your strategy, what I've seen with most property investors, that strategy doesn't really change over the years. The tactical implementation of the strategy is what changes. And that might be price point, that might be the type of properties you're securing. You might be sort of pigeon pairing assets of having a high yielding property with a high capital growth type property. So the tactical execution of it is absolutely critical. But when you think of new property investors, it's okay to have a strategy saying, I want to buy a property, right? Would you say is it okay to go, I just want to get one and then I'll work it out? Or do you need to be really deliberate at the front end? You need to say, okay, I'm going to start investing in property, so I need to know what number 1, 2, 3, 4, 5, 6 is? Or is it okay to just go, I just want to get into the market and get the right one first? And imagine it's about getting the right property first is what's critical.
I still think you've got to take that step back and go, I want to get an investment property. And obviously that's great, but what's the right property for you? Firstly, before you even look in the market, choose the city, the suburb, what's the right property for you? And people, I think, don't sort of sit back and have a think about that. They about the cash flow issues, about the repairs and maintenance, about some of the other headaches. It might sound good in theory that you want to develop that property in 4 years, but then you look at your circumstances and go, well, to develop that property is going to take X amount of cash. You're not going to have that in 4 years. So is that the right property for you to be buying now? Maybe you need to take another step back and go, I'll get something that's going to give me decent capital growth, but a good solid cash flow that's going to keep me, means I maybe get into a second investment property. Maybe that development one might be the third or fourth one down the path. So take the emotion out of it and, really understanding yourself, your financial circumstances, about how you're going to be able to afford these properties in the longer run. And that sets your investor profile. We do an investor profile on people, whether that be blue chip investor, aggressive growth. We analyze people's circumstances, their risk tolerance. And once we've identified the type of investor they are, generally that doesn't change, interestingly, over the journey. It can, if life circumstances change. But once they understand fundamentally who they are, they know then the types of properties to go for. And for some of those clients who are very risk adverse, well, you want to get something newer that's going to have less breakdown, less repairs and maintenance, better tenants, better cash flow. Yeah, the growth may not be quite as good as something that's got more land value, but that's okay. You're not out there to, it's not a race to be number one. It's a race for yourself to build wealth, and that other property might grow more, but all the headaches it's going to give you might mean that you're going to actually exit the market, and that's the last thing you want. So I still think fundamentally you've got to analyze who you are, your circumstances, and that'll direct and determine the type of property you are, not just go and buy anything and then reverse engineer it later.
And that's sage counsel. A lot of people jump in without having a plan, and you end up, and they're typically the property investors who dominate the statistics in Australia, that they own between 1 and 2 properties. I think there's 25,000, Australians nationally that own more than 6 investment properties. So it gives you the sense of what happens if you buy the wrong property first. And typically those properties that you buy, which are wrong at the start of your investment journey, is stuff that you probably didn't think too much about or didn't know where you're going. So sage counsel there from Damian Collins. Now, Damian, I'm going to ask you what the best location was for property investment based on the survey findings, but we're going to go to a break first. So you're going to have to come back and you'll hear all about it. Back in a moment. Welcome back, everyone. It's Phil Tarrant from Smart Property Investment, Damian Collins from Mental Wealth. Now, Damian, your survey, are you sharing this information outside of this podcast? Are you putting a report together or anything on it?
We are, and we're sharing it, though, with the survey respondents, the people the nearly 1,000 or so people, I think, who filled in the survey. they haven't already, they will be getting a copy of the findings from this report, which I think will be interesting for those people. So interestingly, we saw the top two cities for investment were Perth and Brisbane. And when you go back to look at the survey, certainly the proportion of people looking to invest in those two cities was well above the proportion of people who filled in the survey. We had a lot of people from New South Wales and Victoria in particular who filled in the survey, and they were certainly much higher on those other two cities. And I think it's a combination of things. Obviously, the price points in those two cities are substantially lower than particularly in the Sydney market. And I've certainly noticed on the ground, Phil, as you say, we buy nationally, and we're obviously commercial and residential. But I've certainly seen the really significant uptick in investor sentiment, particularly in Perth, but also in Brisbane. That particularly with that affordability barrier, people are going, my servicing's been hurt a bit, so where can I go and buy a property for $450,000 or $350,000 to $550,000, and that's my servicing capability. What can I get? There's not a lot you can obviously get in Sydney and a little bit in Melbourne, but in Perth and in particular, you can still get houses. And we have seen a lot of activity from East Coast investors, sometimes represented by buyers agents from the East Coast coming over to Perth, also going up to Brisbane doing day runs and clambering up 10 properties and going home and for their clients. So yeah, there is certainly a lot of interest in those two capital cities from property investors nationally.
Well, no real surprises, to be fair, Perth, and we've spoken about Perth for many years. And I know you're based in Perth, you buy in Perth, but you buy nationally as well. No real surprises there, but it is that affordability equation. And most people starting off in property investment, the lion's share are going to be sort of acquiring those sort of affordable assets. It's where most people start. It's not where they finish. But it's where they start. So no huge surprises there. You sort of sit there and watch all the buyers agents coming off the plane there at Perth Street. You're going, here's another one, here's another one, here's another one. I guess gives a sense for the growth in buyers agents, and that is an emerging industry sector, and the value and the benefit that they're providing property investors. But not all buyers agents are created equal, right? So there's going to be a point in time when it's probably going to stop being the right place to be buying. When do you reckon that will be?
Well, I think if you're talking about where's a good place to be buying at the moment. Look, I think fundamentally, Perth is, and it has we all know Perth has been has not as gone as hard and fast as we would have anticipated given all the fundamentals. Certainly, it's still incredibly cheap. You can buy houses within 25k of the city for $400,000 and get $450 a week rent. So, given Perth's fundamentally based on the strength of the mining sector. Right now, it's going really well, and the population's booming. And we have the shortage of housing in Perth at the moment is getting back to where it was in that silly period of 15 years ago where prices went over the top. I'm not suggesting that's going to happen now, but it's a real clamour out there in the market to get properties. And we do see, and some of the East Coast buyers agents, they're coming over and overpaying. Certainly, you do want to get a property and get in the market, but I think there's enough good assets around, although they're hard to find. You don't have to overpay, and so look, I think we tend to try and stick away from the 300 to 400,000 range if a client can afford more, because they do come with their own challenges. They're lower socioeconomic, and with all due respect, sometimes those tenants are great people, but sometimes they're not, and we do find there's more problems in those price points from a tenancy point of view. So, but having said that, look, ultimately, if it means buying a property that's 300 to 450,000, or not buying at all, I'd still rather buy one if it still suits your property investment strategy. So I think, look, I still think Brisbane has come back a bit. Look, Brisbane did run away. I think Brisbane's got legs. It's got the Olympics coming up, which will help put on the map. Obviously, that's still a while away, but it's the fastest growing city in the country. And that's, look, when you're a property investor, one of the most important things I always looked at in terms of which cities to invest in is population growth, because it's demand, and more people with a limited supply ultimately always leads to price growth. So I still think Brisbane is, in the long run, it hasn't got as strong as economy as the other three capital cities. Obviously Melbourne and Sydney got a lot of financial services. Perth is obviously very mining. Brisbane's a bit of everything. It's got some certainly mining stuff, but it doesn't have the financial services centres like Sydney and Melbourne. But so its income's a bit lower than those other three cities. But nonetheless, it's got a lot of people moving there just because of the weather and the climate, and lots of good things happening. So yeah, I still think Brisbane is going to be a great performer in the Australian market over the next 20 years.
And I'll conclude with this question, Damian. What's going to stop Perth overcooking again? Because you talk about 15 years ago, things went crazy. Prices were higher then than what some of these properties are selling for now. So there's going to be a time to buy and there's going to be time to stop buying. And I want to try and work out when it's the time to stop buying. But how do they make sure they don't overcook this market again? Or is it, no one's going to stop and say you can't do that anymore. Price is going to keep growing on the basis of people have the appetite to buy. So will self-calibrate, do you think, this time?
Look, I think people have got long memories and remember that crazy period where prices more than doubled in just over 3 years. And I think, mean reversion is something I think that's where things come back to the mean. So when Perth got up to nearly Sydney, prices back then, that really didn't stack up in the long run. If you look back in hindsight's always 20/20, but you look back and go, well, maybe that's clearly overshot the mark. And now I think it's undershot, where it's a third of Sydney. That's crazy as well. It certainly shouldn't be at Sydney prices, but when the median in Perth is 550-ish, in Brisbane it's over 700, Adelaide's 650 odd, and of course I'm talking about house prices here, not dwellings. And Sydney was 1.6. I think it came back to 1.45. But nonetheless, again, those numbers don't calibrate either. Perth should not be a third of the price of Sydney. And so I think you've got a long, long way before we get to that point. If it got to, I think Perth should sit in a line pretty close to Brisbane. And so if it started to overshoot Brisbane by much, Melbourne and Sydney are two biggest capital cities, 5 million plus people. They're always going to be the most expensive. Sydney's got more land constraints than Melbourne, and that's why that's going to be more expensive than Melbourne. Brisbane and Perth, similar constraints on the coast. And so Perth's got a bit higher income. So I think when Brisbane's a little bit bigger, I think they should be fairly calibrated. So keep an eye on that. If Perth starts to get above Brisbane and starts to get too far ahead of Brisbane, I think that's the time you might go, it's starting to get a bit out of control. Yeah. But we're a long way from that.
The time is now, though.
We're a long way from that. Absolutely.
Yeah. So, all right. Well, there's a headline there that Perth is the place to be, and I can see the appeal why, and a lot of it is just the state of the market right now, but also Perth is underweight. So check it out. You can go and get more information around this particular report. Damian, best place, your website, I imagine?
Yes, momentumwealth.com.au. You'll find lots of information, lots of great content. And if you want to subscribe to our newsletter and get market updates, what's happening in property, you'll find a good newsletter and an easy place to find it on the website to sign up to. There you go. These guys have been out a while. They know what's happening. That's Damian Collins, Managing Editor of Momentum Wealth. Go and check it out. I hope you enjoy that, everyone. Remember, smartpropertyinvestment.com.au. Please keep those reviews coming wherever you get your podcasts from. Team get a real kick out of it. Social media, Smart Property HQ is where you'll find us. I'll see you again next time. Until then, bye-bye. The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.